Afternoon from Abu Dhabi. My name is Ute Collier. I'm the Deputy Director of the Knowledge Policy and Finance Center at IRENA, the International Renewable Energy Agency. It's my pleasure to welcome you to today's webinar where we're presenting the results of our recent report, the report of IRENA and the Climate Policy Institute on the global landscape of renewable energy finance. On Tuesday, here at IRENA, we published a preview of IRENA's World Energy Transitions Outlook at the occasion of the Berlin Energy Transition Dialogue. And it quite clearly showed that the energy transition is not on track in many ways, in terms of the deployment of renewables, in the power sector, in the end-use sector, in terms of electric vehicles, etc. And of course, the investment to enable the deployment of these renewables is also not flowing to the extent needed. What the preview of the report called for is an urgent and transformative way which will require a systemic change in the volume and type of investment needed, as well as the public policy support to bring that about. Now, of course, we're saying this at a time of multiple global crises, and they present both a challenge, but also an opportunity in many ways to deploy renewable energy. So it is very difficult in terms of the tighter fiscal space we're seeing at the moment, rising interest rates and uncertain macroeconomic outlook. And all those factors clearly negatively impact investment in renewables. On the other hand, we have an energy crisis which is forcing countries to try and move away from dependencies on fossil fuels and imports and urgently deploy renewables. So that in some ways is pushing ahead the energy transition. And we've seen, for example, last year, which you've seen in our recently launched renewable energy statistics in the power sector, we've seen record renewable power additions, capacity additions of 295 gigawatts just last year. So that some things are happening, but of course, a lot more is needed. So what we're presenting today in the Global Landscape Report tries to take stock of these trends in terms of investments made to date, highlighting trends by technology, by sector, region, source, and financial instrument. So just to give you some figures ahead of the presentation, we have reached a record of $1.3 trillion in 2022, and that's for all energy transition technologies. But those still need to quadruple to get us on a path towards 1.5 degrees C, according to the World Energy Transitions Outlook. If we're just focusing in on renewable energy investments themselves, we've had $500 billion in 2022, but that's still less than a third of what's needed. So as you can see, the challenge is absolutely massive. The other issue is that those investments aren't flowing at the rate needed to achieve the Sustainable Development Goals. One of the key problems is Sustainable Development 7, which is aiming at universal energy access by 2030, is also way off track. We still got more than 700 million people without access to electricity and nearly 2.4 billion people without access to clean cooking at the end of 2020. And the investments needed to solve those issues, these are often, in many cases, we need to have much greater investments in off-grid renewable energy solutions, which are the way to help many people to gain access to electricity and also to renewable, to cooking in an affordable way. And we've only seen around 500 million US dollars in 2021, when we actually need $50 billion. So the scale, the gap is even more massive there. Then, of course, we have seen that the investments often are very concentrated in terms of technologies and also in terms of countries. At the same time, we are still seeing rises in investments in fossil fuels. And we see a lot of fossil fuel subsidies going into the industry as well. So a lot that needs to be changed. In our presentations today, we'll touch on these trends. We offer key insights on how to change this situation and to scale up investments to support a just and inclusive energy transition. So with this, I would like now to hand over to the presenters. So we're going to start with Costanza Strenati from Climate Policy Initiative. She will present the findings of the overall renewable energy investment landscape. Then we have Farhan Rana from IRENA, who will present the findings for the off-grid renewable energy sector in developing countries. And finally, Diala Avila will discuss the new paradigm of public investments that is needed to achieve a just and inclusive energy transition. Then we will have some time for a Q&A session. So please, as we proceed with the presentations, feel free to write any questions that come up in the chat, and we will then do our best to address them at the end. So I'll now hand over to Costanza, please.
Thank you very much, Ute. I hope you can hear me fine. It's a pleasure to be here. As you mentioned, I will give an overview of global energy transition and renewable energy investment trends, looking at sectors, regions which have received investments over time, types of investors providing capital, and types of financial instruments used to invest in renewables. So first things first, the good news is that global investments in energy transition technologies, as you can see in this graph, have increased over time, especially despite the COVID pandemic and recent macroeconomic events, and have reached a record high level in 2022 at $1.3 trillion. Despite this increase, however, as you mentioned, current annual investments are nowhere near enough what is needed to keep the world on a climate-safe pathway. To stay on track with the 1.5 scenarios laid out in IRENA's World Energy Transitions Outlook, annual energy transition investments need to at least quadruple compared to the current levels, and they need to reach $5 trillion, over $5 trillion per year between now and 2030. While renewable energy and energy efficiency remain the largest sectors, receiving together almost $800 billion in 2022, their share in total energy transition investments has progressively declined as other technologies have become to attract larger amounts of investments. This is, for example, the case of electrified transport, which includes electric vehicles and charging infrastructure. Here you can see in the graph in dark green, which grew dramatically in 2021 and 2022. We can go to the next slide, please. So achieving an energy transition in line with the 1.5 scenario also requires a redirection of around $1 trillion per year from fossil fuels assets to energy transition technologies. However, we see that following a brief decline in 2020 due to the COVID pandemic, fossil fuel investments are on the rise again, and continue to attract significantly higher investments and renewable energy assets. Over the 6 years following the Paris Agreement in 2015, some large multinational banks maintained and even increased their investments in fossil fuels at an average of around $750 billion per year. And it is also estimated that $570 billion will be spent on new oil and gas development and exploration every year until 2030. Next slide, please. So in addition to the large direct investments these technologies are receiving, the fossil fuel industry continues to receive considerable support through subsidies. Between 2013 and 2020, we find that $2.9 trillion was spent globally on fossil fuel subsidies. And specifically in 2020, we see that Europe provided the largest subsidies per capita, surpassing the MENA region. We see in Europe a level of subsidy per capita of $113 per person compared to $36 in the Middle East and North Africa region. Again, data for 2021 shows that fossil fuel subsidies doubled across 51 countries in 2021, going from $360 billion in 2020 to around $700 billion in 2021. So for the energy transition to unfold, the phasing out of investments in fossil fuel assets needs to be coupled with the elimination of subsidies to level the playing field with renewable energy and other energy transition technologies. However, to ensure that a just and equitable transition is happening, the reduction of subsidies needs to be accompanied by a robust safety net to ensure adequate standards of living for vulnerable populations. Next slide. So focusing now on renewable energy investments specifically, we see that the global investments reached a record high level in 2022 at $500 billion. Although this, as Ute mentioned at the beginning, still represents less than 1/3 of the annual investment needed for the 1.5 scenario to up to 2030. Moreover, what we are seeing is that investments remain concentrated in solar and wind power technologies. Specifically, solar PV attracted 46% of investments in 2020, followed by onshore wind at 35%, and offshore wind at 12%. And based on preliminary data for 2021 and 2022, we see that this concentration of investments has not declined. Investments have also been concentrated in the power sector, which attracted on average 90% of annual investments between 2013 and 2020, while investments in direct end-use applications such as heating and cooling and transport, which are all essential for the energy transition, have remained comparatively low. Next slide, please. So renewable energy investments have also remained geographically concentrated, with the majority of finance being invested in China, the US, and Western Europe. And this means that more than half of the global population, mostly residing in developing and emerging countries, received only 15% of global investments in 2020. Just to give you some numbers, Sub-Saharan Africa received less than 1.5% of the total amount invested globally during the period from 2000 to 2020. And similarly, least developed countries attracted less than 1% of annual investments between 2013 and 2020. What is worse is that the share of investments flowing to these regions has been declining since 2018 at an average rate of 36% per year. So things are not improving. Next slide, please. Looking at, if we can go to the next slide. Oops, yes, next. Yes, thank you. So looking at sources of finance, the private sector provides the majority of global investments in renewable energy and was responsible for 75% of total finance committed during the period 2013-2020. And because the private sector tends to prefer more mature and less risky technologies and markets, this is one of the reasons why renewable energy investments have remained so concentrated as we've seen. For example, in 2020, 83% of commitments in solar PV came from the private sector. Meanwhile, geothermal and hydropower relied on public finance with only 32% and 3% respectively of investments respectively coming from the private sector in 2020. Next slide. Focusing on private sector investors, we see that commercial financial institutions and corporations are the main capital providers, accounting together for 85% of private finance going to renewable energy in 2020. As we can see over time, there's been a slight shift in the mix. Up until 2018, private investments came predominantly from corporations, on average 65% during 2013-2018 period. But in 2019 and 2020, a larger share of investments was provided by commercial financial institutions. If we go to the next slide, we can see that this trend is in line with the general decline in the share of equity financing in the sector. You see here the blue sections of the bars. So the share of equity financing in the sector dropped from 77% in 2013 to 43% in 2020. And equity finance was largely provided by corporations and households. These accounted for over 80% of total equity finance provided. Throughout the period analyzed, the share of debt financing here in yellow, brownish, more than doubled over the period. So it moved from 23% in 2013 to 56% in 2020. And this is likely linked to the maturation and consolidation of major renewable energy technologies such as solar PV and onshore wind, leading to higher levels of debt in these markets, as lenders are better able to envision regular and predictable cash flows over the long term, also facilitated by PPAs in many countries. If we go to the next slide, we can see the other side of the coin. So looking at the public sector provided less than 1/3 of renewable energy investments in 2020. We can see that state-owned financial institutions, national DFIs, and state-owned enterprises are the main sources of public finance, providing more than 80% of capital in 2020. The same year, MDBs, so multilateral development financial institutions, provided 9% of public finance. This was in line with past annual commitments. And these multilateral DFIs accounted for about half of the international flows coming from the public sector. We can also see that commitments from bilateral development finance institutions fell 70% in 2020 compared to 2019. And this means that multilateral and bilateral DFIs provided less than 3% of total renewable energy investments in 2020. So I'm happy to give the floor now to my colleague Farhan for more insights into the off-grid renewable energy investments. I'll stay on for questions. Thank you.
Thank you, Costanza. So hello, everybody. And as mentioned before, this year we've also included in the report a dedicated chapter on off-grid renewable energy investments in developing countries. So just for context, given some of the numbers we heard, renewables attracted almost $500 billion in 2022. Compared to that, the off-grid renewable sector attracted just $3 billion in the last 10 years. So given some of these numbers, this sector is really a microcosm of the overall financing landscape. But its impact is immense. While only $3 billion was invested in this sector over the last 10 years, more than 200 million people have gained access to electricity from these solutions. So that's quite a high return on investment, especially when considering the associated socioeconomic benefits of electricity access. Going forward, off-grid renewable energy solutions will play a crucial role in closing the current electricity access deficit that stands at more than 700 million people. So this year, we look at the 2010 to 2021 period, particularly zooming in on the last 2 years since the COVID-19 pandemic began. And the pandemic, as you can see, was particularly concerning for the sector. Supply chain disruptions led to an increase in manufacturing and distribution costs, particularly for solar home systems. Meanwhile, household incomes shrank, and we heard cases of customers defaulting on their bills. For companies, they had to find new ways to secure working capital, while a lot of their assets were tied up as receivables. And so together, these challenges led to a decline in investments in 2020. But in 2021, investments reached a record high of more than 500 million. And this was led primarily by strong investment growth in Africa, particularly West Africa and East Africa. However, investments in other regions have yet to return to pre-pandemic levels. This is also down to increased support from public financing institutions, particularly from DFIs, and also from the increased concentration of investment among a few large companies that are driving majority of these investments. This is why we also see that the average transaction size between 2020 and 2021 doubled, meaning that investments are now spread over fewer deals. All that aside, current investments, although they reached a record high, are well short of the 15 billion needed in the sector annually to achieve universal access. Next slide, please. So looking at investments by product and energy use, the majority of investments continue to go to solar home systems, about 1.75 billion over this 2010 to 2021 period. And by extension, most of them go to the residential sector. But in recent years, we've seen more investments in micro and mini grids, which attracted about 650 million or 21% in investments during the same period. As you know, these investments are generally made with a broader customer base in mind, typically because mini grids are relatively more capital intensive. So for them to be commercially viable, additional demand is required from commercial and industrial applications, as well as other community-based uses for power in schools and hospitals, etc. So over time, we see that the needs of the off-grid sector are expanding from beyond basic household to more commercial and productive uses of energy. And as such, companies are increasingly diversifying their services across different products and segments. So as you can see, the share of investments going to commercial and industrial applications has expanded over the last few years. In 2015, it was just 10%. And in 2021, it was almost a third of all investments. So powering these applications is key to promoting local economies and also creating jobs and economic growth while enhancing food security and resilience. Next slide, please. So in terms of financing instruments, over this 2010 to 2021 period, 95% of the investments were split almost equally between debt and equity, and grants provided just 5% of the overall investments. Some interesting findings here in recent years are that the share of equity has declined over the last 2 years. The reason being that the typical equity investors were venture capitalists and private equity firms, but their contribution have declined, particularly due to the challenges I mentioned earlier due to the pandemic. Also, just a general slowdown in private equity and VC activity as interest rates have risen globally. And historically, in the off-grid sector, there's also a limited track record of exits and capital recycling. And as a result of all these factors, fewer equity investors are coming in. But meanwhile, on the positive side, the contribution of debt increased over the last few years, particularly as debt-preferring DFIs bolstered their support during the pandemic. This year, we also made some updates to our database to see how much local currency financing is coming in. And a remarkably positive trend is that established markets such as Kenya and Nigeria are seeing more local currency debt financing. Over the last 2 years, well, 2020 and 2021, about 28% of the debt was denominated in local currencies. However, again, this is concentrated in just mainly in Kenya and Nigeria. But as revenues in the sector are typically generated in local currencies, low-cost local currency financing is definitely preferred for the next phase of the sector's development. Next slide, please. So as mentioned, we see a decline in private investments in the sector over the previous 2 years, but public investors and institutions, particularly DFIs, stepped up to cover the shortfall. So in 2021, their contribution increased to $260 million, a 67% increase compared to pre-pandemic levels. This makes them the largest public capital providers to date, and notably, their contributions since the pandemic constitute half of their overall contributions since the previous decade. So over this time, many COVID-related relief funds were announced. We also see an increase in results-based financing, more blended finance approaches, as well as mobilization of several grants to power healthcare facilities in sub-Saharan Africa. But despite the announcement of several of these funds, there's only a small amount that has been actually dispersed to date. So there are some implementation challenges on the ground. Next slide, please. So given all these trends going forward, we see that there is a considerable gap in the current investments versus the investments needed to achieve universal access. So we need significantly more public and private contributions, both to support companies, but also on the consumer side to bridge affordability gaps and create market awareness. As said, local currency financing is the preferred option for the next phase of the sector's development. But companies also need to increasingly improve their unit economics and focus on profitability and exits at the same time. Tools like financial aggregation have tremendous potential to attract large investments and target investors with large minimum ticket sizes. So a range of options are available, but all of this hinges on the very important role of public financing, which I will now hand over to my colleague Dayala to elaborate on further. Thank you.
Thank you, Farhan. So I will just summarize very briefly the findings of the report that were presented by Costanza and Farhan. And also we will see what does this mean for the public sector or for governments. So just a quick wrap up. As Costanza mentioned, global energy transition-related investments in 2022 reached $1.3 trillion in 2022. This needs to quadruple according to the WITO that we just launched this week. Between 2023 and 2030. Within those, investments in renewable energy at $500 billion in 2022 need to more than triple each year between 2023 and 2030. And within those, investments in off-grid renewables at $500 million in 2021, because this is the latest year we have data for, is far short of the $15 billion needed annually, which includes mini grids between 2021 and 2030. So as you can see, the scale needs to increase significantly. But not just that. So between 2013 and 2020, power generation assets attracted on average 90% of investment in renewables each year. But preliminary data suggests that this share has gone up to 97% in 21 and 2022. So which means that it's not only that we need to scale up our investments, but also investments need to be more distributed towards end uses, including heating and cooling and transport. So those are less mature technologies that are not able to attract as much investments. In 2020, renewable energy for end-use applications received less than 5% of the total, which was down from 8.5% in 2013, But in 2022, preliminary data shows that this has gone down to less than 3%. So we are going in the opposite way of where we need to go. We need to dedicate more funds towards renewable energy for heating and cooling and for transport. So if we look at the 2022 numbers, we estimate that investments were about $13 billion in end uses. Those need to increase to around 270 billion per year until 2030, according to IRENA's WITO. So it's not just that the concentration of investments are within certain mature technologies, but investments, although they are growing globally, are increasingly concentrated in a few developed markets. So more than 85% of the global renewable energy investments in 2022 benefited less than half of the world's population. And the disparities in per capita investments between the global north and the global south has been even increasing with time. So in 2015, you can see here, the per capita investments in Europe were 22 times that of sub-Saharan Africa, and North America were 23 times more. And this disparity has more than doubled. So now Europe is at 41 times sub-Saharan Africa, and North America receives 57 times more. So going back also to what Costanza presented, between 2013 and 2020, 75% of the global investments came from the private sector. But the private capital tends to go to countries with lower real or perceived risks, or to frontier markets only when effective risk mitigation facilities are provided. And a large percentage of the population remains underserved. And it's the same for technologies. The private capital goes to technologies that are proven, that are mature, that are less riskier than others, which is one of the reasons why we are seeing a heavy concentration of investments in the power sector, or in more specifically solar PV and onshore wind, and more so now in offshore wind. So, but this means that the lowest income populations are paying most of the energy, or are paying most for often energy, basic energy that is universally recognized as essential for elevating poverty and promoting socioeconomic advancement. Because as the private sector goes to riskier environments, of course the risk of return will increase and the cost of capital will increase. So this means that the lowest income populations will end up paying the most for energy. So this means that we need a much stronger role for the public sector, and more specifically for public financing in these contexts. And we cannot continue relying only on private capital. Otherwise, we may risk to keep widening the disparities. So when we look at the risk mitigation instruments that have been applied, of course, they have worked, and they have worked in many countries. At IRENA, we have analyzed risk mitigation instruments in many publications. You can see them on the left, and we have really illustrated risk mitigation examples, and because they have worked in so many places. But when we look at risk mitigation instruments, we see that sovereign guarantees are the ones that receive the most attention, or are the ones that are more and more in demand by private investors to guarantee their investments. So they have been preferred for lenders, and they have been seen as a one-size-fits-all solution for all risks that could be faced. But such guarantees are treated, first of all, they are treated as contingent liabilities by regulators and agencies like the IMF, which may hamper the country's ability to take on additional debt for essential infrastructure projects. But also, sovereign debts are already stressed to their breaking point in many emerging economies, and especially in the context that we are seeing today. So which means that many countries cannot access affordable capital in the global financial market, or neither can they provide sovereign guarantees as risk mitigation instruments. So what do we do with these countries? So in these contexts, we need more innovative instruments, and we also need a more comprehensive way of defining risks. So how have risks been defined in the current context, we have been focusing the definition of risks in the way of, in a way that we have only been looking at them from the perspective of risk return profile, so only from the investor's point of view. And we look at risk only as the risk of the project not return or having a good return on investments. But what about the environmental risks or the social risk or the risks of leaving most of the population with no access to energy, or the risk of not meeting the SDG goals? And of course, those are not the responsibility of the private sector. Those are the responsibility of governments. And since there are limited public funds available in the developing world, the international community must step up. So as mentioned by Costanza, so far, or last year, in 2020, multilateral and bilateral DFI provided less than 3% of global investments. So when we break down, when we look at those investments, we see that they were mainly in the form of debt financing at market rates. So which means that they are asking for interest rates charged at market value, which again takes us to the riskier the context, the higher the values, or the higher the cost of capital. Grants and concessional loans amounted to just 1% of total renewable energy finance in 2020. So since the interest rates are the same, the only difference is that when we have DFI financing, we are providing the loans to the developers, and that's it. Even when we look at the Just Energy Transition Partnerships, or the JETSPs, we also saw that they are mainly provided as loans with very few grants, and even the loans are really at market rate. So what does this mean? This means that public funding must flow into the renewable energy sector, covering, of course, all the segments of the value chain, the energy sector, and more broadly, the economy as a whole, for this just and equitable energy transition to take place. So we propose a framework for public financing that can be sourced either nationally, which is now the domestic national DFIs are providing the most of the financing, as Costanza showed, but also internationally from international sources, which is through international collaboration and flow of money from the global north to the global south, which will be very important in achieving the energy transition and also the socioeconomic impacts or benefits that it can achieve. So intermediaries to channel this money can include governments, but also DFIs. They can also include, for example, global funds like we just mentioned, the JETP, but also the Green Climate Fund, export credit agencies, but of course, multilateral and bilateral DFIs. They can be channeled through different instruments. For example, government spending like grants, like rebates, like subsidies. They can be channeled through government or public debt, so including new issued debt or credit instruments or concessional loans or guarantees. They can also be channeled through direct ownership of assets or equity, and also through funds that can fund policies, for example, like PPAs, when the payment for PPAs is lower than what we are getting from the consumer, especially, this difference can be funded through these public funds. So in IRENA, we have our our comprehensive policy framework that is defined, or that includes deployment policies, integrating policies, enabling policies, and policies for structural change and just transition. And these instruments, or these public funds, can flow through the renewable energy sector, as I mentioned, the energy sector as a whole and the economy as a whole, through these policies. Now, finally, what is the way forward? So first of all, the availability for capital for public funds needs to be increased, and the way we lend to developing nations need to be transformed, especially when we are talking about renewable energy projects that should not be seen as only a sector that can bring profit to the private sector if and whenever they are willing to venture into that. They should be seen, these renewable energy projects should be seen as at the center of development, as basic human rights, and we need to change the way that we allocate public funds for them, and the way we lend to developing countries. So this is, in this sense, we need more funds need to be provided more in the form of grants or concessional loans, and we need to stop making the poorest people pay the most for their energy. The loss and damage fund is one example that is now in discussion for COP, and we wait for COP28 to see how this what this fund will mean for renewable energy projects. But at the same time, it is very important to stress that public finance and policy should continue to be used to crowd in private capital. So we are not saying that this model does not work. This model does work and has worked. We're just saying that it doesn't work everywhere, and it needs to be complemented by different policies in specific contexts. But we need to continue putting public finance to attract private capital. And this can be done in instruments that go beyond risk mitigation. For example, and these are just examples, but in the report we provide more detailed recommendation. So policies can be used to incentivize an investment swap from fossil fuels to renewable energy, both by banks and national oil companies. We need to mobilize institutional investment and also promote the greater use of green bonds for renewables. And of course, there is a there's a large pool of funds that we can tap into from philanthropies, that we should do so more in a more explicit way. And we need to go after philanthropies in a more explicitly to direct these funds into renewable energy projects. So with this, I end the presentation from my side. Thank you very much. And I hand back over to Ute to go to the next Q&A session. Thank you.
Thank you, Diana, Farhan, and Costanza. That was quite a lot of information. And we've had quite a bit of interaction from the audience already. So some of the questions we answered in the chat. So everyone please check, including a link to the report and also the link to the page where the presentation will be uploaded. Okay, we're going to take a couple of the questions live. And the first one we'll pick is from Corinne Neal, who says, could the panel comment on what seems to be a scarcity of investable renewable projects? Diana, please.
Thank you, Ute. This is my favorite question. So yes, we do have investable or bankable projects, and those can be developed in a way that can be bankable and attract investments. And IRENA does support countries in designing policies to support more and more bankability. Also, we have a division that supports projects even at the project level to be more bankable. And for those, we have a set of policy instruments that have worked and that we assume will continue to work. But we, in this year's edition and in the recommendations that we just gave, we like to focus on projects that are not bankable and that will not be bankable in the foreseeable future. We are talking about developing countries that are experiencing tight macroeconomic situations, that have just gone out of COVID, where inflation is high and where that are mainly defaulting. We see a lot of countries that are defaulting. Their local currencies are going down every day. So in those countries, it is more difficult to find bankable projects the way we define bankability. So in this situation, this is where we need to take a different approach and to, as I mentioned, redefine risks and look at the risks not only from the point of view of investments getting their return, but also from the point of view of failing people. So the risk of failing people needs to be brought more on the spotlight.
Thank you, Diana. And then we've got, well, one is a comment from Christine Singer, which is about the investment we're talking about is, of course, commitments, and they don't equal disbursements. So Costanza will make a comment on this, as well as the question further down. Sorry, I can't find it just now, but it was about R&D and whether we include R&D investments. Costanza?
Yes, thank you so much for the question. Actually, so the distinction between commitments and disbursements is a really important one. And this is better highlighted in the methodology, the underlying methodology that we published together with the report. I think I added a link in the chat or answering one of the questions. So the point is that while disbursement data would provide a more accurate picture of what are the actual volumes flowing into renewables each year, the choice to actually track commitments from our side is really due to data limitations. And this is because disbursements data are not always available. And as we track data from several data sources, using commitments data really helps to ensure that there's data consistency across all the different sources that we use. But yes, I mean, this means that when looking at trends, flows are sort of front loaded. So the investments are tracked on the first year of the investments. But in the report, we also recognize that you know, it takes longer, like sometimes while commitments is done in the first year of the investments, then disbursements come at different rates and for the same investment throughout the life, not necessarily the lifetime of the project, but you know, later in, not necessarily in the first year. And also some investments might be commitments, some funds might be committed but not actually disbursed. I mean, this is sort of taken into account into the database retroactively. So when we look at commitment flows, we also revise retroactively in cases where projects have been cancelled, for example. So just to answer also the question on R&D investments, these are currently not included in the database. The data really focuses on direct investments into new renewable energy assets. But recognizing that this is like a very important part of the puzzle and part of the industry, CPI has been looking at how to comprehensively track R&D investments into renewables, as well as investments into refinancing of existing renewable energy assets. So we are really trying to integrate this into the renewable energy data that we have put together. I hope that answers the questions.
Okay, thank you. Now, we've just had a flurry of questions on green hydrogen. Let me kick off and then I'll pass over to Costanza and Costanza and Diala, sorry. Of course, everyone talks about green hydrogen these days. It's not a miracle solution. In our World Energy Transitions Outlook, we do, of course, consider hydrogen as an important solution, especially for the hard-to-abate sector, you know, things like steel making and maybe some shipping, etc. May I stress, not for solutions where electrification is a better option, like heat pumps, for example. And we do need to see a major scale-up of investments, of course. So electrolyzer capacity needs to go up from, I mean, it's only at 0.5 gigawatts at the moment, needs to go up to almost 6,000 gigawatts by 2050, which will require a lot of extra investment, probably $170 billion US. So this is quite a challenge. Now we see a lot of involvement from governments at the moment, where they're making commitments, they are developing strategies. And in fact, if you look on our website, we've already published a number of reports, both on the technical side and on the policy side. But clearly there is a challenge at the moment of actually getting projects underway. So Costanza, do you want to say something on how we've considered that for the report?
Sorry, could you repeat that again?
So how to what extent we've been able to take into account green hydrogen investments for the report?
Yes. Green hydrogen doesn't fall into the flows or the database for renewable energy investments specifically. In the report, we have a section on energy transition technologies where we include some investments in green hydrogen. We also have a box, sort of a deep dive on some investments on green hydrogen. The data doesn't come from CPI, but we've been able to, capture some of those trends from other sources. Yeah.
So how do we get funding for feasibility studies? Diala, you've got some thoughts.
So I will answer the feasibility studies, and then I will hand back over to Farhan, who wants to add something on green hydrogen investments. So just for going back to the feasibility studies, so at IRENA we also do a lot of work on the design of competitive procurement or auctions or tenders, and in there we analyze the incidence of putting the responsibility of having resource assessments either on the government entity or on the developers. So we see that depending on who takes on this responsibility, we will see impacts with regards to for example, the price that will be provided or bid by the private developers. So in contexts where the government or multilaterals, whenever they are included or involved in designing the bid, in contexts where we want to reduce the risks on the developers to attract them because it's already difficult to attract them, or in context or in situations where we want to reduce their costs and their transactional costs to support them and to attract them into the bid and to support them provide or present lower prices, the government can take on this responsibility, or the multilateral development bank that is included or that is supporting the process. Like, for example, we saw the IFC support a lot of auctions in developing countries, and in those instances, like for example in the scaling solar instance, it is the multilateral or the IFC that takes on the resource assessment or the feasibility studies, and then the developer can rely on this data. So I'll just hand back to Farhan, who wants to add something on green hydrogen investments.
Yeah, and just, the question was the feasibility studies specifically for green hydrogen. And of course, what Diala was saying absolutely applies to new emerging auctions, which are inherently more risky. And of course, government can step in and at least co-finance some of these studies. Farhan.
Yeah, thanks, Ruta and Diala. Just going back to Costanza's point on the investments going to hydrogen. So as mentioned, yeah, there's very limited coverage of hydrogen projects and investments at the moment, but I think the figure for 2022 was something like just over 1 billion invested. So when we again say invested, that's projects that reached financial close. So the money has been legally obligated. But what we see, if you look at the overall list of projects in the pipeline, there's a very small fraction of projects that have actually reached the stage of financial close. There's just in Africa alone, there's something like $60 billion worth of projects that are still in the pipeline that have yet to reach financial close. And what we're seeing so far is that these projects are those that have some sort of off-taker agreement in place. So there are some challenges in order to get these projects to that stage, and that's something we're looking into in our future finance-related work. So we'll expand on it there. Thank you.
Great, thanks. I'm just checking what else we have. Sorry, yes, I wanted to pick up this one. There is a question from someone about whether we have more detailed info on the cost side. Absolutely. We have a whole report which we bring out every year which focuses mostly on the power sector, renewable energy costs, and it does also have differences by country and region. So we can put in the link, but you can also find it on our website if you just do a search on renewable energy costs. Would anyone like to take any of the other answers? There's one on carbon finance platforms. Costanza, is this something CPI looks at?
No, we haven't really looked at it in detail yet. We haven't done any studies on this, but it's certainly something in our radar. It's not really captured in the database at the moment, but it's certainly like a good point to raise. And we are actually, we are exploring. We're currently thinking of studies on that. We don't have any current insights on that specifically, unfortunately.
But I mean, we're certainly aware that carbon finance is playing an increasingly important role, for example, in energy access on the clean cooking front. So yes, it clearly can play a role. I think we also shouldn't over-rely on some of these, especially when they're from the voluntary carbon markets. Okay. Anything else? There are various questions. I think because we're out of time, we probably can't get around to answering some of them, especially on EU-specific stuff. But please have a look at the report at our website, where you will find a lot of additional information, reports on a lot of these questions, because, you know, of course, investment is only one side of the renewable energy and energy transition puzzle. We publish a huge amount of information on the policy side, on statistics, on all the technology side of things as well. So please have a look, and if you have any further questions, you can come back to us. And thank you again for Costanza and a great collaboration with the Climate Policy Initiative, and thank you to all our audience for the great engagement. Thank you. Bye.
Thank you.
Thank you.
Thank you.